Okay, so our next session is pensions planning and promoting financial products. On our esteemed panel, we have Lisa Picardo from PensionBee, currently campaigning for a 10-day pension switch guarantee. PensionBee. Lucy Castledine, she's Director of Consumer Investments at the FCA. She's been working at the regulator since 2012. And Rezaah Ahmad, who's founder of WiseAlpha, who started out at Deutsche Bank before launching his company in 2014. And moderating our session is Phil Clements, the CEO of Finspector, an AI marketing compliance tool.
So Phil Clements, CEO of Finspector. So really we're helping firms that are regulated, particularly in different markets, monitor and review their financial promotions for compliance. I have a background in financial service over 10 years. I used to work in Bloomberg's index business. I saw S&P out there, who was one of our competitors. And then before that, worked for a company called Record Currency Management, sort of on the buy side in New York and in London. But maybe just to begin with, we'll allow our panelists a little bit more time to introduce themselves, their firms, and sort of how they relate to the topics that we're talking about today. So maybe Lisa, do you want to start first?
Yeah, sure. Well, pensions is my topic. I live and breathe it. I work for PensionBee. I'm their chief business officer here in the UK. We have around 300,000 clients, customers that we serve across the UK. We have around, well, just shy of 7 billion of assets under administration. We are a leading pension provider that is built for the consumer. So we help them across all parts of their retirement journey, when they want to consolidate their pensions, when they want to add contributions, and when the time comes to withdraw. We've recently also launched a customer proposition in the US, so we will be helping consumers over there roll their 401ks, which is their equivalent to workplace pensions, into a new IRA.
Lucy.
Good morning, everyone. Just checking it's still morning. So Lucy Castledine, Director of Consumer Investments at the Financial Conduct Authority. Linking back to the 3 Ps, I think I'm probably here from the promotional aspect today. So from a consumer investment perspective, I've got the supervision of wealth managers, advisor firms, peer-to-peer, crowdfunders, SIP operators, and platforms. But I also have our Financial Promotion and Enforcement Task Force, which deals with all regulated firms' financial promotions, and some of those pesky unauthorised firms who may be either purposefully or slightly straying into promoting to UK consumers without appropriate authorisation. So a very broad remit. I'm very happy to expand on the work that we've been doing in the financial promotion space.
Hi, I'm Rezaah Ahmad. I'm the founder of WiseAlpha Technologies. We pioneered fractional corporate bond trading, which is now, kind of growing in popularity around the world. We obviously started off in the UK, increasing access to corporate bonds for retail clients, which is a major problem which everyone's identified, and there's obviously a lot of initiatives going on in order to improve access. We're proud to have started that process and led the way. We've also worked with the UAE government to this year, just a few months ago, open up fractional sukuks, or sukuk, which is the Islamic equivalent of corporate bonds, to the entire retail market. So, gradually we're kind of working to kind of liberalize, the access to direct fixed income around the world. And so obviously going to be working on initiatives here in the UK. Very interested in seeing from from a pensions angle, how we can align kind of the predictability of income, from corporate bonds into, individuals' target returns and risk profile over their pension horizon.
Excellent. I think maybe to begin with, we'll focus on the first P of pensions. And if I cast my mind back, it was 2012 when the UK first started introducing auto-enrolment. And I think since then there's been lots of innovation in government to think things like, for example, releasing pensions dashboard, which I think was supposed to come out in April this year, that has got extended to next year, possibly the year after. So I think the first question I'll probably ask to Lisa, just saying, auto-enrolment and some of these activities really brought pensions access to lots of different people in the UK. But how can really fintech, education and regulation help with this change and enhance on it?
Yeah, I think the first step is sort of understanding what's wrong with the current system that we have. So you quite rightly said auto-enrolment has been a huge success. It's brought a lot more people into the fold of saving for retirement. But the work is not done. So the UK does face a savings crisis. We know that millions of people simply aren't saving enough for their retirement. They are disengaged with their pensions. They find it overwhelming. They find it incredibly complex. They're faced with one of the unintended consequences of auto-enrolment, which is that they have multiple pension pots to manage. And so they're very easy to sort of lose control of. And so that is sort of the problem. Lots of people not saving at all, lots of pension gaps building up, etc. So I think in terms of the solution, it requires action from all three. So fintechs, education and regulation. Let's start with maybe education. So financial literacy rates across the UK are depressingly low. The average person has a sort of level of a 10-year-old. So that's sort of what we're dealing with, and that is really important context. So more needs to be done on education at all levels. It needs to be in the classroom and in the curriculum. It needs to be at university. It also really needs to be at that first point that people are starting to save. So when they get their first workplace pension, traditionally there has been very, very little education given as to what that means. And a lot of people will blindly assume that, okay, well, I'm saving something. I've got some minimum contributions or something going out on my payslip. I don't really understand what that means. It's not really today's problem. We really need to change the thinking around that. So yes, definitely more in terms of education to start closing the knowledge gap and the confidence gap that people have. In terms of fintechs, well, I'm well placed to comment on that because we are a fintech proposition that was really born out of the lack of anything that is consumer focused. So workplace pensions are directed at corporates or companies. They are not built for the individual, whereas our proposition is built for that individual. So it has to take them on a journey. And what we know from our data is that the more engaged people are, the better their retirement outcomes. Right, so the more likely they are to contribute into a pension, the more they are likely to have a bigger pot at the end of the day. So that's the very simple goal. How do you do that as an innovative fintech? You are able to build, as we have done, a digital first proposition so that people have their pension available to them in the palm of their hand. The more they find that product engaging and exciting, the more they start checking their pension balance every day and seeing it move, the easier it is that you make it for them to contribute or to consolidate old workplace pensions. The more likely they are to actually do something about their retirement outcomes. So I think a very important role for fintechs also in education and providing tools to customers. So what we do is we make sure that we do talk to our customers in all sorts of different ways. We have a podcast, we have blogs, we send out emails, we communicate with our customers to bring their levels of sort of education up. We're non-advised, so we don't give advice, but we are able to obviously guide them with customer service from our aptly named beekeepers. So a lot that can be done. And then the last piece is regulation, and you mentioned this. You mentioned the pensions dashboard, which is something that I think is going to be huge for consumers. A lot of people just have no idea what money they have, and they have no idea then as to how that translates to an income in retirement. So this is going to be the first time that people will be able to log into a portal and see all of their pension pots, their state pension and any private pension pots that they have side by side. And I think for some people that's going to be incredibly illuminating, and for some people it's going to be incredibly depressing. But it's going to be a really important part of that journey to more engagement. And then, I will hand over to Lucy in a second, because I'm sure she'll talk more about the FCA's initiatives on things like targeted support. But the other thing that has happened is the Pension Commission has been re-established. And I think that is really about tackling some of the big problems. So that is about looking at auto-enrolment and actually some of the failings that it has. So, we need to improve contribution rates or have a path to improving those rates. We need to make sure that groups that are currently completely excluded, like the self-employed, and they have a vehicle or an avenue to be able to save easily. So I think a lot of that work on looking at who is participating and what rates there are is important as well.
There's a huge amount I could unpack there, but maybe I'll just fling that over to Rezaah, actually, because I know that you have recently launched things like ISAs, SIPs on your platform as well, and I'd just be interested to get your take on the sort of innovation, educating people, particularly on things like fractional bonds, right? And getting those into pension pockets is quite interesting.
Yeah, I mean, I think, there is, in our space, there is a massive gap in terms of, consumer knowledge and direct access to fixed income. And so, we're obviously trying to change that. The fractional approach does that. It gives people the opportunity to kind of buy into corporate bonds, which trade in very large denominations, with institutions. So it's opening up that avenue, because I think most people that we speak to, they have a problem, particularly on the SIP side or the self-invested side. They really are the people who take out SIPs. Tend to be kind of wealthy, but also a little bit older, because they're starting to think about their future and retirement. And one of the key focuses for them is to try and predict and calculate what they're going to generate. And so fixed income bonds in particular are really interesting for them, and they want to use their SIPs. But currently, the way things are from a regulatory setup and just market access, it's just a real problem. And so, we often have to, it becomes a difficult problem when it comes to SIPs. But ISAs, I think we've solved that one now.
Yeah, I remember when I was at Bloomberg and we did a lot of work on the index side of sort of targeted yield portfolios, etc. And there was like a big interest in that, as you said, because growing retirement age, you want more certainty around cash flow, maybe less growth in your portfolio. So very interesting. One thing you mentioned, Lisa, is about, you talked about the education side, and maybe to piggyback this over to Lucy, I think the attention mechanism of the world is changing a little bit. So before, it's no longer just the written FT content. Now you've got people posting stuff on social media, and the algorithms around that aren't really set up to perpetrate truth. They're to really harness your attention, right? So typically, and that means that your content tends to remain on the fringes, because it's more extreme content that tends to give you that 7-second dopamine hit when you're flicking on Instagram or LinkedIn, etc. And I know, Lucy, you stood up recently in the House of Commons Treasury Committee to address this growing concern of finfluencers. And actually, I remember afterwards, I think in June this year, you worked with a number of different regulatory bodies around the world to spearhead some action against sort of unauthorized finfluencers or influencers. So I'd love to hear a little bit more about that and how that links into sort of pensions and promoting sort of financial assets themselves.
Yeah, look, I mean, we're not going to shy away from the fact that we know consumers are turning to social media to get advice, and I'm sort of doing that inverted commas advice. And one of the fundamentals that I will say today is we need good actors, we need regulated firms to be in that space to meet the consumer where we know that they're going. But then there is also the flip side of that, which is making sure that we try to clean up that side of things so that, the general consumer is not going to that unauthorized firm, going to get really dodgy advice and get pulled into high-risk investments which are fundamentally just not suitable for their needs. Now, we've been working with big tech and online platforms for a number of years now, going back to sort of 2020, 2019. You only had to search, how can I get a good return on my investment? And you would be literally spammed with ads via Google. Now, through the work that we did, they've introduced what I sort of call their financial promotions policy. And when that was introduced, we went from sort of 100% scam ads to virtually zero overnight. And all of the other major tech platforms have now implemented that as well. So that's a massive step forwards. But that's paid for advertisements. That's quite easy for us to tackle. Literally can turn around and say you're probably the recipient of proceeds of crime. Where it becomes much, much more challenging for us is for with the organic content. And that's what's led to, first of all, just a UK week of action back in 2024. But then really, finfluencers, online platforms, they are jurisdiction agnostic. The power was with a lot of the regulators coming together. So 9 different regulators across, I think it was 6 jurisdictions. We all agreed kind of a headline that we would go out with, but we left it very much down to the individual jurisdictions to see what action they wanted to take. Now, just to give you an example, what that led to from an FCA perspective was 52 warnings, But those 52 warnings on those individual accounts collectively had 6.5 million followers. That's huge. So 52 to 6.5 million. What that also led to was 3 arrests, and we were pleased to announce last week the charge of 3 individuals, and they will be going to, I think it's the Southwark Crown Court in October. But really fundamentally, the point that I really need to make when it comes to online platforms is we can issue the takedown request, we can ask for the information to come down, and it does. But what's happening behind the scenes is these illegitimate actors are setting up what we sort of call lifeboat accounts. Within 24 hours, the same content is appearing that's just been taken down. And that's where the big ask is for tech platforms to do more proactively, spot this content and take it down before it even reaches the consumer.
Yeah, I think one of the things that often gets left behind is the importance of education early. So, you know, in school, I remember, I mean, I don't know if it's changed that much, I don't think it has, but we never, you know, we would learn how to cook. That was a basic learning requirement for life, you know, but we never had any lessons on financial education. You know, simply what is a mortgage? What is your pension? You know, how to open a bank account? You know, what is a stock? You know, just the basics, you know, which if you just did, you know, a very small course, continually updated, and, you know, the FCA could also, you know, include some material about, you know, how to watch out for scams. You know, if you get taught that, you know, from the age of 16 onwards, you know, then basically, you know, you're already literate with your, you know, your social media. You'll immediately kind of think in your head, oh, red alert. Is this person saying something to me which I should be, you know, thinking, is this the right thing to do? So I think that's really important, and I think that you know, just an initiative there would help solve a lot of the problem.
I think also it's getting even more complicated. I don't know if you saw in Wimbledon this year, there was an article that came out around a social media influencer, and it turned out it was just an AI influencer. It was a completely computer-generated image that had some of the gained tens of thousands of followers over a few days. And so I think that now, as I said, it's changing even more. So it's becoming more difficult. Sometimes there's not even a person at the end of that social media handle who's actually perpetrating that misinformation, which makes it even more difficult for people to vet that process. And actually outside, we were talking, Lisa, about how your firm, you have a vetting process for social media influence. So I'd love to hear a little bit of how you think about that at PensionBee.
Yeah, sure. I mean, we take it, obviously, with the regulators sitting next to me, very, very seriously. Everything we do, like, we are all about building trust, and we are a proposition that is seeking to reach, like, the mass market. So it is important for us that we do use all of our marketing channels to talk to people, and we do use for influencers as well. But I can tell you the process around that is well, it's certainly a process. I mean, we do have them vetted. We work with an agency to pre-vet. We obviously, once we are comfortable, all of the content is checked by us. So nothing goes out of the door unless all of the content has been reviewed. And we review all of our content with respect to, FCA guidelines and advertising standards and all sorts. And for social media, we don't consider that in a different way. So we take that same sort of high bar. We make sure risk warnings are in place. We make sure that things are really clear and understandable. And, we watch out for things like trigger words that shouldn't be used. But we do use AI to actually do some of the vetting of our content, like a first look, and then we have a human check that goes afterwards. So I think if you do build in the right controls and the right processes, and if you are a business that takes your brand very, very seriously and is all about trust in financial services, you can definitely you can do the two things, and you can use influencers to reach audiences that you wouldn't ordinarily reach, but you just have to do it in a very careful and considered way.
Yeah, it's funny because we have a lot of social media requests from our clients, and one of the things that's quite interesting is sometimes it's a limitation on the platform itself. So, for example, we just created some LinkedIn connectivity, and the native APIs or connections that LinkedIn provide doesn't necessarily allow you to look at anything beyond the first post on a LinkedIn carousel. So if you actually, for our platform, if we're building something that helps people flag financial promotions risks, there's actually limitations based on what we can get from the end platform providers. And I remember from Lucy, you in your report, I think that you did on the with the Treasury Committee, you talked about, I think it took 6 weeks or something for Meta to take down certain posts. I suppose my question really is, how do you actually work in practice with these providers to make sure they're giving you the data they need or taking down the data you don't want in real time? What does that look like? Because some of them aren't listed here, they're listed in different jurisdictions. So how does that actually work?
Where do I even start with that? So internally, we've developed the technology to be able to scrape the website is the starting point. So we look at, it's close to 500,000 potential financial promotions. That's filtered down to a manual review. I think it was about 3,700 last year, of which we had nearly 20,000 advertisements from regulated firms either taken down or amended, and we've issued thousands of alerts against unregulated firms as well. But what we've also done is we've partnered with an external agency who will do the takedown requests for us. And the main rationale and reason for that is, funnily enough, some of the tech platforms aren't actually that responsive to the takedown requests. So it's better to have an external agency literally bombarding and checking and making sure that that is taken down, rather than one of my divisions sitting there and doing that. But we have no powers over these tech companies. So it has been through persuasion, providing a very solid body of evidence to them that actually they are causing harm to UK consumers. And it's a continual process because the technology continues to evolve. There was some talking of the sort of the deep fake scams. There was a CEO of one of our regulated firms that was deep faked. And the traditional thing that you see now is that it's come and join me on this WhatsApp group. It's a link on social media to begin with, and it goes through to a WhatsApp group, and that's where the harm really happens. That particular firm, and there were 2 or 3 actually over the course of a week, could not get any traction with with Meta. We got involved, and eventually, on that one particular occasion, that was actually taken down. But it's through persuasion and it's through the evidence base and proving the harm to the UK consumer. Because if we don't do that, what we fundamentally need to do is build trust in this industry. We need to create that trust. We need to create space for the good firms to be able to innovate and meet the consumers where they're going for that advice in the first place. And to do so, we need to clear up the less scrupulous end of the industry.
Yeah, I'd love to know if you had any impact, if you've ever had any dealings with Truth Social, and whether and whether you've had any success there. But maybe, Rezaah, I don't know if you want to comment on that from your perspective, because obviously you're trying to attract the attention of sort of consumers to fractional bonds. I'm not sure if you've got any comments on sort of how you think about that, how you do that, how you make sure that you remain compliant in this sort of world of different attention mechanisms.
Yeah, no, I mean, we obviously take financial promotions pretty seriously, and we've obviously seen a lot of the guidance from the FCA, so we review that and we go through a rigorous process. I mean, actually, most of our approach at the moment is to engage technologically with other large platforms who already have a base of customers, larger reputable firms, who do to give access. I think that's our priority. I think utilizing social media more actively is something that we will consider because we do see that it is a valuable resource tool, as well as obviously a potential risk area as well. But it's a potential. It's what people use in order to get information. So you do need to engage with that. And I think it's just it's a careful process, because if you're trying to market using external people, it can be a bit unwieldy at times, because if you can't control exactly what someone says, the only way you could do that is through the language that you give them in their, brief and their agreements, that they can't stray from the material that's been given, things like that. So it is an area that, it's got to be carefully done. It's something we'll look at in the future, I think.
Yeah, absolutely. Maybe changing track slightly and backtracking a little bit. I think I wanted to ask yourself, Lisa, a little bit about, we've talked a little about pensions, we talked about sort of financial promotions. I'd love to focus a little bit on some of the frameworks. So, for example, the value for money frameworks and making sure that pensions get good outcomes, right, for different savers. I wonder how you think about in the context of different groups, right? Because you've got different people at different stages of retirement. There's different channels, as you mentioned. So podcasts might be one attention mechanism that you use for younger savers. It maybe attracts their sort of attention. But how do you think about that with the spectrum of consumer audience you have to make sure you're delivering value to them?
Okay, let me unpack that, because I think you've asked. I think you've asked a few different questions in there. Okay, value for money. So that's something that we look at we have been looking at forever, really, where we will take all of our investment plans that we have and we will do an examination of value for money to make sure that they do indeed provide good value for money. So we will look at performance and we will also look at fees taken into the mix. And for us, again, going back to the fact that we are for the mass market consumer, so we have customers from 18 to 80, we have customers with £10 in their pension pot, we have customers with millions of pounds in their pension pots. So we really are for everyone. So for us, we have to have investment plans on our platform that are suitable for everybody. So we actually have well diversified plans that are managed by BlackRock and State Street, essentially, so the largest money managers in the world. And we have default plans to help guide people where they are more unsure. So a default for the under 50s, a default for the over 50s. And then the other plans are all quite well differentiated. So a long-winded way of saying, yes, we take value for money very seriously, and actually it's something that personal pension providers do, and it's something that workplace pension providers have done less of. But with changes in rules, I think they will also come under that value for money framework. So that's the first question. The second part, you'll have to remind me what the question was.
So more just how you do it for different you talked a little about different audiences, and how the attention, maybe how you attract the attention based on where people are on there.
Yeah, so I think, to be honest, all of those propositions, all of those 6 plans need to speak to people in a way that they can understand. So all of our communications around like plan performance or blog posts or podcasts that we produce, they have to sort of speak to everyone. So I don't see it as being different for a sophisticated investor with millions of pounds or for a self-employed person who's just starting up. I actually don't see it differently at all. We just need to make sure that everything is sort of not open for misinterpretation. It is clear, it is balanced, and it represents correctly.
Yeah. And I think it's interesting because there's a trend, right, within the population where we talk about these different options that people have. And this is where I'm going to pass this to Rezaah, actually. I think we've got quite an inflationary environment. There's a rising life expectancy. And actually, you mentioned kind of a couple of firms or asset managers you work with, but there is a question around, is the pension pot in its current format fit for purpose? I know there's a big push from government to push for sort of private investments, particularly in DB plans, etc. And so I'd be interested to know, and Rezaah, maybe you can start this. Do you think the pension pot is fit for purpose right now? And do you think there's other financial products that people should be putting in there? And if so, what should they be and why?
Yeah, I mean, look, I'm always a great proponent of choice because, not everybody's the same. A lot of people do want to have control over choosing, the trajectory of their investments and the types of risk and return that they want. So, coming from that standpoint, so obviously I'm pro increasing choice. I am also a great proponent of self-investing. So one of the things that I recognize is that the UK is far below the type of savings and investment culture that you have in the US. And that's a problem, both, nationally, competitively, but also on consumer outcomes, giving the people the ability to generate, what can be, if they do it right, life-changing decisions, so giving people that capability. So I am, I'm a proponent of increasing choice. I do also see with inflation, so this is a very important issue, and I think the whole industry doesn't understand the basics, but, of the way that everything works. So we have a monetary system whereby sovereign nations, when they increase their monetary supply, they, issue debt. And that's a problem because if you actually go back to, theory, I mean, there's no way that this is ever sustainable on a global level. Only some countries can benefit because you're always continually having a compounding effect that can never be paid back. And so naturally that has led to inflation globally. I mean, you can see over the last 100 years, I think the value of dollars, for example, it's like 1% of what it was. I mean, it's crazy. So basically, when pension firms and investors and just generally everybody who's involved in the industry think about the future, they need to be thinking on a real inflation or real basis. What is your return after inflation? Right now we're in a high inflation environment because we've been spending a lot of money. and we've been spending a lot of money on the wrong things. So most of the debt that you see in the US particularly and the UK comes from war spending, which is destructive. And so we've had, money effectively saddle and enslave both countries, as well as other countries who spend, on that type of activity. We've seen that, effectively destroy the real value of people's investments and consequently in the future. So what a lot of people need now is to, I think, in my view, just as a, personal investor, I would like to have greater control in terms of investing my own money. I'd like to have greater choice. I'd like to be able to, create a fixed income ladder, or, so I can say, okay, look, I only want to hit 5% because I'm pretty conservative, but I want that, over the next 30 years. That's what my pension investing is going to be. My other investing, which is more discretionary, I'll take some risk there, but I just want to set that aside. So, yeah, I'd like to see that improve. I'd like to see, less. I'd like to see, the kind of mindset of, just going with one provider because that's pretty easy. So it tends to go through the employer. If, for example, Nest is quite popular, but it charges 1.8% of your contribution that goes in. That's ridiculous. I mean, that is outrageous. So, there definitely needs to be more choice to make things more competitive, pricing-wise, and also much more, flexible choice-wise, and to allow people to get a more predictable return. So fixed income obviously is where I think, there's definitely some improvement to be done. And what else was going to say? I mean, I think that is pretty much where I'm coming from, which is that type of open approach.
I don't know if you want to respond to that, Lisa, because I feel like you've obviously mentioned that you're using 2 asset managers. I don't know if you want to have a counterpoint to.
Yeah, I think choice is important, but again, it goes down to who is your customer and understanding them, because I think there are SIPs and SIPs. There are SIPs at one end of the scale that are for clients that may be advised. There are SIPs that allow you to have more bespoke arrangements, and it requires a certain level of understanding. But again, let's look at the mass market. Let's look at what the average person understands. What we find is that people are completely overwhelmed with the complexity. And what's really interesting is once you give them their pension on an app and they look at their balance and they can see it moving up and down, they have a lot of questions. Some people don't necessarily even understand that their pension is invested in the stock market. So I think there is a long way to go before the sort of, let's take the average mass market consumer, sort of starts to want to play around with more complex arrangements and making more decisions. What we typically find is that they actually want something. Most people want something. They want to know that it's well in good hands. They want to know that they can trust where it is. They want to know that it's a plan that will grow for them. And, plans that give 100% equities will already do that for low fees. So I think there are plenty of good, simple, straightforward investment plans that are out there actually for people. And I think, it is important to have choice and it is important to have innovation across the market. But I think you just need to really be careful that you are offering products and solutions that match the general level of understanding of the consumer.
Yeah, I think it's funny. I like more complexity, but then I also take the point that I've worked in finance for over a decade. So you kind of take for granted what you know and what you don't know, right? So, go on, do you want to respond?
I think what we're saying is that, choice doesn't necessarily mean, let everybody invest in anything they want. What it means is not having, just one or two choices, which are the obvious default. I mean, if you think about the way things are behaviorally right now, most people, it's a black box to them, the pension contributions. They get, when they set up with their employer, they might get a letter and, a login to Nest, but many people never log in. And obviously that comes to your point about the app, right? But, it just goes to a default setting. You can, obviously, if you go into your dashboard, you can, look at other plans, but, yeah, it is a bit of a problem. But I do think that greater control, doesn't necessarily have to come on choice. Doesn't necessarily have to come with weaker choices. Do you see what I mean? Right now, I mean, what you don't really want to have is more concentration of investment holdings going into the largest wealth managers like BlackRock, because obviously they utilize that power for other purposes. What you want to do is have a healthy market which is competitive, also from fees perspective, but gives people choice.
I'd love to hear Lucy's opinion on this from a regulatory standpoint. And I'd say that I asked this question tentatively. So, I mean, well, how do you consider that balance, really? Because there is obviously more providers, freer choice, maybe more complexity, but then you have simpler choice, fewer providers. How do you even consider that when you think about regulation, policy, all these other things?
Look, at a really, really high level, this is about providing consumers with the right information, balanced information, reward and risk to enable them to make an informed choice. But I will also go back to the point that Lisa sort of said earlier, which links into the work which is imminently going to be coming out on targeted support. We know that there are a huge number of consumers out there sitting on over £10,000 of investable cash, and they're not doing anything with it. There is a huge inertia. And through to the targeted support proposals, we think that it will bridge that gap between what we've got out there at the moment, which is guidance, and then full fat advice to enable consumers to start engaging. And I don't think there's just one silver bullet in all of this. So we've mentioned the pension dashboard. That could be game changing. It could enable people to start actually realizing what it is or isn't that they've got. And firms need to be ready to answer the questions, because I think they will come. It might be a slow and steady increase, but it will come over time. But there's no one silver bullet when it comes to making the regulation. It's a real fine balance. But fundamentally, it's about choice, competition, innovation, and making sure that the right information is provided to the consumer at the right time to make an informed decision with what is fundamentally their money.
I mean, I'd like one simple solution, which would be to allow you to, in that pension dashboard, to allow you to connect your stockbroking account and then make that choice. Because people who've already got a stockbroking account obviously know what they do. Well, they're used to investing in stocks. So why not, just make that connection to the pension side of things?
I thought you were going to say fixed income broking account.
Well, sure, but you know what I mean.
Exactly. But I think the principle here is don't overload the consumer, right? Because it can get incredibly complicated. And I want to take it back, because Lisa, you talked about this a little bit, is that it seems like the trick is start early, educate people, make sure it's consistent. So I'd be interested to know, with this trade-off of complexity, but also trying to keep things simple and educate, how do you think about that, and how do you consider that for your end consumers?
Yeah, I think with pensions, I mean, they are very different from other types of investments. So the whole trick of pensions is they are, your money is invested for decades, and there are two ways to make sure you have a decent retirement outcome. One is making sure you actually contribute enough into the pot, and you do it early, so we know that little and often is a good approach. And the second is obviously through the growth of that pension, and I think we've talked at length about the opportunities for making sure that money works hard for you. So yeah, I think two ways, but I think it is really. I think the big challenge is making sure that people are actually engaged with what they have, and that they know how to manage better and how to, as Lucy said, make informed decisions. And I think what we see, and we have a more engaged customer base, because remember, when they've come to us, they're coming to us because they're like, oh, I want to consolidate my pensions, or I want to do something differently, or I can't add into my old workplace pension because I've left that job. I want to have a new pension so that I can contribute more. So we do have quite an engaged customer base as compared to other providers. And we do see that people are, the more they see, the more they engage, the more they are actually contributing and doing. So, and they will, just by doing that, improve their retirement outcomes.
And maybe this is where I sit on the fence and say, I actually am a PensionBee customer.
Oh, I didn't know that. You should have told me that at the beginning.
There you go. So the thing is, when you do your retirement, I just don't want to have the headache of selecting the portfolio. So I want to choose my risk tolerance, and someone else can figure that out. But to Rezaah's point, I actually also do want this other part of my portfolio, maybe my ISA portfolio, maybe the other bit, to actually play around in markets where I have a little bit of an understanding, like, for example, the bond market. But I think that's quite a nuanced case, right? Because I don't think everyone comes from that level of experience. I think a lot of people just I want that headache to go away, and I want it to be app ready, app friendly, and let it rip, really.
I think one of the things actually is that's interesting is that more and more people are learning about gilts, because obviously the yield has jumped since 2022. I mean, if you think about it, the government needs funding. You know, investors are looking to make yield. You know, why not use your pension pots to, you know, help both? You know, and you can obviously, you know, create a ladder on that as well. I mean, so I think just a greater choice. You know, so what I'm saying is there's greater choice of product there. It's a low risk product. I mean, unless you believe the UK government's going bust. But, you know, it's simple things like that. Additions are interesting additions to choice, which don't necessarily add complexity, I think.
Yeah, I mean, the Gelt thing's interesting. Yeah, we could unpack that with Mansion House DB pensions going through buyout, kind of funding a bit of that market, which but that's a whole nother conversation. But maybe to sort of transition to think about more that last point around financial products, there's been quite a lot of innovation in market around different products that can fit in the pension pot. So we touched on some of them, but you've got things, for example, not just the underlying asset, but there's the structure as well that has changed, right? So I think LTAFs were introduced in 2021, and I think, was it July this year? They said they're now available in ISA format as well. So I'd love to get the opinion of the panel, really, and I'll open this to anyone, really. Just what do they think about not just the underlying asset, but all these new structures that are coming out beyond just sort of liquid public assets? What do we think about those and how they're positioned within the context of pensions? Is that a good thing? Is that a bad thing? Indifferent?
Well, I could maybe start off. I can probably take it from a credit standpoint. You know, so one of the popular themes right now is that a lot of private equity and private debt firms want to offload their risk onto retail LTAFs, you know, and other, you know, retail listed products. You know, I generally think that, you know, an asset class should have transparency. You know, listing, you know, the underlying asset class should have transparency, and a listing brings that. You know, we have transparent information, you know, things like that. What you'll find, because I come from this space, is that most of the private credit world, you know, the private debt that is issued, you know, they kind of misreport the default rates, because they kind of amend it, you know, before it happens. So you're not really comparing like for like with, say, for example, you know, corporate bonds which are listed, you know, and so I would say there should be a little bit of caution there using these types of structures. But I do think, you know, it's important to bring liquidity into other general areas of investment for the economy. And part of that could be to give some extra access. It just depends on the nature of the asset class. I mean, investing in speculative, you know, land investment and hotel projects, you know, across the world, that's not something that I think retail investors should be massively exposed to. But, you know, that's just my view.
No, I get it. And yeah, I mean, as you mentioned, you've got people like Apollo launching a private credit ETF. So you've got this weird, a liquid wrapper with a very illiquid asset underpinning it, which seems to have very nice management fees, but maybe not necessarily best for the end consumer.
Top of the market. Exactly. It always happens. It always gets offloaded to retail at the top of the market.
Exactly. So we've got about 15 minutes left. And I did want to, I'm conscious that we are the 15 minutes before your lunch break. So I thought I'd open up to the floor for questions to see if anyone had anything they wanted to ask the panel.
Yes.
Hello. Sorry, I'm just wondering where you see the role of ETFs, if you see the role for ETFs at all in that, or would you advocate for more sort of direct ownership by somebody in their SIP or ISA, or would you see a structured, diversified product as structured in the way that it's, you know, high income Venezuelan debt, say, or China growth, or some such. Whatever, not necessarily those two extremes, but do you see a structured product in the best sense, an ETF, or an individual approach, trying to pick bonds yourself and having some fractional percentage of them? Which is the best approach, would you say?
Well, I don't think it's a question of which is the best approach. I think it's what the approach that the individual wants. So right now, you know, people buy and sell stocks or they buy funds. They have a choice. And, I think that's the same that should apply to the fixed income market. There's obviously a lot of ETFs that are out there, but the problem with an ETF is that, it can often trade at a discount or a premium at any point to the net asset value just because of the way the market's moving. It is also a bit of a black box, and so you're kind of relying on the manager, obviously. And I suppose that's the reason people choose these things. But, I think the difference between fixed income and stocks is that the mindset of the individual is to target a return, a yield, to suit, what he wants to achieve in terms of a return by a certain date. And so if you don't give them the choice, then they don't have that ability to do that. I think, with a bit of education and more access, more retail bond issuance, the fractionalization approach we have together combined, you can bring that education and that portfolio building into play and give people the tools to, achieve that target yield or predictability, that I think a lot of people are crying out for.
I think I would just, when I was at Bloomberg, we worked with Eurex Exchange to launch some bond credit index futures. And the reason I mention that is that it's those kind of innovations that allow then things like fractional bonds and different types of investments to occur in sort of different portfolios. It's quite difficult in fixed income, especially to create a diversified basket of fixed income, because actually, if you think about it, if you are someone issuing that security or selling that security, you sometimes, if you're have to hedge your balance sheet, right? So you need something in the derivatives market or something in the market that you can use to take the other side of that trade, so you can just take a spread. So I think that that's very common in equities, right? You've got mini futures, you've got fractionalized equity, all this sort of stuff. But that is now coming to the fixed income world in force, and I think technology has really helped accelerate that. So I think to sort of add on to that question, I think that there's more to come on that side of the equation. And funnily enough, it's actually that example I gave was the only reason that it was possible to launch index-linked credit futures was because there was huge ETFs, passive ETFs, that tracked those indices. So it meant there was a hedging instrument for the issuer of for the other side of the future. So it's all related. The liquidity in ETFs helps produce that derivative market that in itself helps produce innovations to allow different asset classes like fractional fixed income to get into portfolios.
I listen to a lot of the influencers and podcasts to get sort of ideas, etc. You mentioned that you kind of vet the information that they produce, etc. How kind of scalable is that if you continue to do that? And is there a way to sort of streamline it to make it a little bit more accessible?
Is that for me?
Yeah, I guess.
Right.
I guess for yourself and Lucy.
Why not? I think we use influencers, but it's not the key part of what we do. So that's all controlled in-house in our marketing brand and comms team. So finfluencers are a part, an element of it, but a smaller element. I think we use technology to actually be able to vet all of the content. So it does a first pass, if you like. So in that way, it's actually very scalable. And then the AI is actually fed with all of our guidelines. So not only the FCA's guidelines and all the regulatory considerations, but also our own guidelines. So actually, it is quite scalable. And then we will always give it that last human check and overlay and tweak and sign off, because it's always good to be incredibly paranoid.
Yeah, I was just going to come in off the back of that as well. So I had a little bit of a brainchild back in 2022, 2023. When I said to the organisation, I want to use a finfluencer to engage with the finfluencing audience. Because look, let's face it, you guys might follow the FCA on social media, but the bulk of finfluencers and the people actually that we need to reach don't even know who we are. So we actually went out and partnered with a finfluencer, Sharon Gafka. The aim of that was actually to get the information that we needed to get out there to other social media individuals who may be thinking about going into sort of the influencing space. So it is doable. Similar to what Lisa said, the vetting process can be quite tough. Well, it is tough. And finding someone who passes the vetting is possibly even tougher. But it's definitely something that we are seeking to do more of for the reasons that I sort of set out. You know, the people that we want to reach, the people that we want to engage, to enable people to engage with regulated firms, to enable them to engage with their pensions, to build an investment pot for the future, we need others to help us reach that audience.
I think it's also about, you know, what kind of content you're trying to get out there, because like I checked in with my team yesterday ahead of this, and they told me that 98% of the content that is out there that we use influencers for is actually just educational content, and it actually links back to, you know, blogs and podcasts and other sources of educational content. So that's really what we're trying to achieve by it. We're not linking out to sign up to PensionBee or things like that. We're actually just trying to like bring up levels of education. So I think it's important to consider like what's the goal of the content when working with influencers.
Instead of giving a shameless plug for the firm I represent, I'll just talk a little about how tech in general I think is helping this. Large language models, and particularly something called agentic AI, is very much helping with the monitoring, review, the checking of social media influencers. So, for example, with an AI agent, you can effectively train it on the FCA COBS rules, your own bespoke rules and checks, right? And then you can essentially feed it content in any format, because you can tokenize a video, you can tokenize a transcript, you can tokenize an audio podcast, whatever it might be. And then it can be fed against those rules or those checks. And then in a very quick process, it can then flag where the risks are, having the human in the loop at the end to sort of make sure it's verified and done it correctly. And the nice thing is the human can give it feedback, right? So it learns your preference over time. So in consumer duty, tone of voice is a big thing. So actually, if you have more nuanced, subjective checks that relate to, you know, okay, this is something that's very nuanced to my organization, you can give it that feedback. So there's us, but there's a lot of other firms that have now come up over time with tech solutions to help scale this problem where compliance and marketing just want to get stuff out the door quickly in different formats, and compliance have a really tough job of, I'm going to have to watch, 6 hours of podcast this week and iterate on that. But actually you can speed up that process by using some of these tools, which have only come around because of LLMs and agentic AI in the last couple of years, really.
Thank you.
Hello, I've a question for Lucy. Lisa mentioned the key things that are going to, affect your pension outcomes or contributions and growth. But for many workplace pensions, the default product is like a mid-level risk. Even if you're 25 years old, you're going to be put in at like a 4 out of 7. I note that the FCA is talking a lot more about reward and the upside of risk. Is it something that FCA will be encouraging, like default workplace, to be a bit more, pro-risk, higher risk? Is that something you'd be looking to do?
So this is where my myth-busting hat goes on. We constantly sort of get the feedback that no, let me start from a different place. What I think has happened is the high risk warnings that are in place for good reason on really high risk products have morphed into the mainstream type space. Now, my boss, Sarah Pritchard, comes out with a great phrase, which I'm going to get wrong, so please don't quote this back to me, back to her on this, but if a firm and their compliance is 10% away from the rule, if a firm's lawyers are 10% away from the rule, if my supervision team is 10% away from the rule, and if my FCA lawyers are 10% away from the rule, all of a sudden we're 40% away from where the rule actually started. So we actually think there's a huge amount more that can be done within the current environment. And yes, you will hear us talking about benefit, reward, and risk. There's some of the research that's been done by one of our regulated firms showed us that with the tiniest of change in a risk and reward warning, that's not a phrase, don't take that away today. A tiny change resulted in 23% more people taking up a stocks and shares ISA. And it's the tiniest of changes that you probably wouldn't even realise. Now, there was some nervousness about doing it. We weren't actually engaged on it, but it's perfectly fine. It's perfectly within the rules. So yes, I think there's much more that can be done. There's much more that can be done. We can innovate in that space. But the high-risk warnings, they are there for good reason. They are high-risk products that are not suitable to the ordinary retail investor. In the mainstream space, come and talk to us.
Hi, this is for Lucy. I don't know whether you attended the panel earlier that I was moderating, but I think we can all agree that financial education here in the UK is not what it could be. And in my time at CMC, I'm no longer at CMC, one of my biggest frustrations was not being able to reach our client base because they had to opt in to receive marketing materials. And to some extent, I think that sort of creates the space for social media companies to promote bogus content. I was basically victim of a deep fake AI earlier this year. Is a sponsored post, and I approached the FCA about it, and they weren't interested. Now, last year, there is a point to all of this. Last year, Facebook and Instagram, I think consumers were victims to around about £39 billion of fraud as a result of a lot of these ads that appeared on Facebook, Instagram, and then went to WhatsApp. What's the FCA doing about that? Because there's a money trail, because if they're sponsored posts, someone's paying for them. But also, the FCA could make it very easy, or a lot easier, for regulated firms to engage with their client base and educate them. And I think to some extent you're a bit of an obstacle, or the regulations are a bit of an obstacle, should I say, to engaging with our client base. We all want what's best for our clients. We want good consumer outcomes. We want the FCA to help us do that.
Right, so let me start with the private electronic communication regs, which are not owned by us, and they are the marketing restriction that you're talking about. But we are working with DCIT, DWP, a bunch of other government agencies who own the regulations in that space, because we do recognise that as a potential barrier for targeted support. So that particular point noted, but it's not actually our regulation that is the barrier there.
Could you lobby for that?
So we are, that's what I'm saying, we're working with the other government agencies. We see it as a fundamental potential flaw, and actually some of the statistics from a targeted support perspective, just as an example, because it's fresh, the consultation's just closed, they're saying that the PECA rules prevent them from reaching 50 to 70% of their client base who they think could benefit from targeted support. So it's very high on our list, but it's not our regulation and it's not our power to actually change that. But we are working very, very closely with other government agencies who do have the power to make amends in that space. When it comes to the social media companies, I have been working with them. I have got the scars, the wounds, the war stories for 5 or 6 years now. But we do not regulate them. So everything that we have achieved with them has been voluntary. Now I can go back to 2019 when I had Google CEO sat in front of me saying, "Sorry, we don't implement UK-centric policies. We only implement global policies." Now, the nature of all of the jurisdictions across the globe means that Google could have been faced with hundreds, if not thousands, of different policies that they needed to implement. We got them there. We said, actually, Google, you're now pretty good. Rest of the online platforms, you now need to play catch up. We have got them there for paid for advertisements. Although we are seeing that some of the fraudsters are finding ways of getting around it. Yep. We're working with them to try and influence them and try and get them to move even further. What we have got as the backdrop, which is coming, is the Online Safety Act, where Ofcom will be the regulator from a systems and controls perspective to be able to take action. Now, I think we can probably all agree that it's quite right that Ofcom are focusing on things like sex trafficking, child pornography to begin with, but the financial fraud codes will come in the next year or so. We will be a trusted flagger as part of that process, so we will be able to provide a body of evidence to Ofcom to say, Meta, Google, whoever it may be, Platform B, I'm not going to say Platform X, which I usually do, because that actually is a platform. Platform B, here's the body of evidence to prove that they are not meeting the codes. You need to go and have a look at them from a systems and controls perspective. So we will do everything that we can. we're constantly talking to the platforms, but it is through powers of persuasion, strong arming, and at times holding them publicly to account.
Yeah, because to all intents and purposes, these are financial promotions. They're using my image or my peers, to basically rip customers off. And nothing has been done about it. I had to spend money litigating against Facebook myself to get these ads removed. That shouldn't be the way things are done. You know, the regulated firms are not the firms you need to worry about. It's social media.
You're preaching to the converted. You know, the amount of work that we've done in the unauthorized space, the amount of warnings that we issue, the amount of takedown requests. You know, I've got a team that are just constantly, proactively scraping, but that is where we, as a nation, cannot prosecute our way out of this. You know, even for those big court cases, we're now not getting court dates until 27, 28. That doesn't send the here and now message. That's why we need the platforms themselves to proactively find this content. The more that everyone in this room and others can feed them, they're the big machines. They've got multi-billion pound, trillion pound budgets. I'm the little FCA with virtually no budget, right? But I've got them to where they can voluntarily. They now need to proactively step up and they need to be held to account. But until that we kind of get the fraud codes coming in, it's through powers of persuasion and edging them there and educating them that I think we'll see the difference.
And shouting a lot.
Sometimes.
Well, look, I think it's a good time to pause there. If you've got any other questions, the panelists will be out during lunchtime. But can I just give a hand, just say thank you to our panelists for today.